Welcome to the LivXplore Podcast. If you like what you hear, please hit like and subscribe. All right, welcome everyone to the LivXplore Podcast. This is our second episode. I'm Sean Payne, founder and owner of LivXplore Real Estate and Lifestyle, and today we have again with us Isaiah Chass, the founding agent. Isaiah, welcome.
Thanks for having us, and we're excited to bring you guys some more content in episode 2.
Yeah, looking forward. Hopefully this will be a little bit smoother than the last one, although I thought that went pretty well. And so today we're going to talk about what's going on in the market, what we see happening, and kind of like pull out our crystal ball and see like what's going to happen over the next 12 to 24 months. A lot of noise right now in the media about, interest rates, inflation, what's going to happen in the market, price is going to drop or prices are dropping, things of that nature. Seems kind of like, a lot of people, I think that, something's going to happen similar to the last foreclosure crisis, and we're in a totally different world, different market that way. And so just kind of want to, go through those things that way. Isaiah, you show a lot of homes, to buyers almost on a day-to-day basis. What are you hearing from your buyers? Like, what's their sentiment? What is their expectations in this market that way?
Yeah, so I think all the buyers left over now from the pandemic, meaning those that didn't get into a property during the frenzy when you had to, compete against 10, 12 offers, incredibly over asking, those were all very emotional buyers. They, in order to justify, writing those types of offers, you had to be a little bit emotional about it because logically they didn't really make sense unless you just wanted to be a homeowner, which, there are those buyers.
And with those offers, being that there were so many, a lot of them were cash or big down payments. So it was very competitive that way. So.
Right. And now I think those left over are definitely, they're more wanting to get a bit of a deal. Maybe not so much a deal, but they're not as driven to write substantially over asking to get a property. And that's the reason why they're not, they're still looking at homes. They didn't get an accepted offer at the time. That being said, I think the mindset has changed from where it was 6 months ago, where everyone knew that the sellers held all the marbles, and that's the way it was. You had to put your best foot forward to get an accepted offer, and that's, the way it was. Now, buyers that I've noticed are wanting to see if there's a little bit of wiggle room. I think
right.
They saw what happened at the last housing crisis, and they're expecting or thinking that that's what's going to happen now. So they're just that's the mindset where they think they're going to get a better deal. That's not really the case. But on the flip side, sellers are also going to have to be a little bit more willing to negotiate with buyers, and they're not going to have 10 offers on the table where they can, just get the absolute highest possible price.
Right. Yeah, I mean, I think, even though you're not going to get those 10 offers, but you're going to get like maybe 2 or 3 offers. And because of that, like, before, if you were a contingent sale and you're getting beat out, now's the time to write those offers. Or, if you were like a lesser down payment, 10% down, 5% down, 3% down, you're getting beat out. Now we're seeing that those offers are getting accepted that way. And like you're saying, those are the people that may need a credit to lower the interest rate at this point to make that deal work for them. So you get like those 2 or 3 offers, but there's a few more stipulations in that you just have to work with, as a seller, you have to be able to work with those, be willing to work with those buyers and, maybe buy a credit or provide a credit so they can buy their rate down, something like that.
Right.
That being said, but yeah, I mean, a lot of this I think comes down to that, again, there's that I think people have been conditioned a little bit to think that the market's going to have like a great drop. As of right now, I mean, all the data that I've seen has shown that we're going to keep kind of ticking along, and it just comes down to supply and demand, that no matter how high the interest rates have gone up, we have not built enough homes. And whether that's locally, regionally, nationally, we need more homes. And so even though rates have come up, we still have a pool of buyers that can still afford that and still want to buy a home. Nationally, there's reports all over that we need to build somewhere between 1 million and 7 million homes. The National Association of Realtors have said that we need to build 6.8 million that way. And Congress has been working on the Build Better Back program and allocated, I think, about $1 trillion to subsidize the building of 1 million homes, but that's just not enough. We need more. I think 2017, the Board of Supervisors in Sonoma County identified the need for 30,000 units to be built immediately. I think they've approved about 80% of that up to this point, but that was before, I think we had one set of fires, but we've had, a series of fires, lost 5,000 homes since then. And as well, we had this exodus from out of San Francisco, Silicon Valley, that way up here. So I think a new analysis would show that we probably need a lot of homes still to be built that way. And so again, that comes down to even though that rates have gone up, we still have this pool of buyers that can afford them and they want to live here. It's also important to note that the North Bay, even though prices have come up and interest rates are up and things feel really unaffordable right now, we're still in one of the more affordable areas in the Bay Area. I mean, the East Bay is more expensive to live in, obviously San Francisco and Silicon Valley that way. And I think you put together, a presentation here kind of showing what home prices are going up the corridor and why it doesn't look like, as of right now, we're going to see any price drops. So
totally, and obviously there's a different sort of money down in Silicon Valley, but as you can see here, for those of you that aren't watching the video and just listening to it, we put together homes, like Sean said, up the 101 corridor that are similar across the board. 3 bedrooms, 2 bathrooms, around 1,800, 1,900 square feet, with lot sizes close to 8,000 or 9,000 square feet. The first property you can see in Campbell, it's 3 bed, 2 bath, 1,800 square feet, 7,700 square foot lot, sold for $2.25 million.
Right.
All these properties sold within the last 30 days. Go up a little bit higher north. You'll see a property that sold in San Jose, similar 3 bed, 2 bath, 1,900 square feet, 8,000 square foot lot, sold for $1.65 million. Similar in San Bruno, 3 beds, 2 bath, 1,700-ish square feet, almost 9,000 square foot lot, sold for just under $1.7 million. Where you really see that price difference is jumping north of the Golden Gate Bridge.
Sure.
Once you get into Nevada, you can see here a similar property than all those in the past, sold for $1.45 million.
And you would see Tiburon and Sausalito, those are
Right.
anomalies. Mill Valley that way a little
Right.
bit. So those are the anomalies. But yeah, once you get up to Nevada, things start changing a little bit.
Totally. And then even from there, once you get into Sonoma County, prices significantly become far more affordable. When you're looking in Santa Rosa, similar property than those in the past, sold for $775,000. Another sold for $920,000. And the one in Windsor sold for just under $900,000. So it doesn't take a rocket scientist to see that prices are far more affordable.
Yeah, in some places it's a third of what Campbell was when comparing Santa Rosa, second to last one to Campbell, or in some places half that way. And we have a great quality of life up here too.
Totally.
A lot of things to do, as we know that way. So yeah, that's really interesting. So even though we feel that we're not affordable comparing to other places close around here, we still are, and that's why that exodus keeps continuing coming up here that way. And what's a little bit even scarier is that in the last couple of weeks there's been a lot of articles on home builder sentiment, and there was a survey done a few weeks back, and builders now are pulling back on projects. So there's going to be even less new homes built over the next year or so than what has in the past, which again is going to contribute to that supply and demand issue and that shortage that way. So there was a really good interview, and you can find it on YouTube. Jerry Howard, who is the CEO of the National Home Builders, he was interviewed by Bloomberg News, and I encourage you to check it out. But he was really insightful and talked about what's going on with home builders and said, that a lot of them are pulling back from building the new spec houses and going into like large remodeling projects, which makes sense. But there's hundreds of thousands of construction jobs that aren't being filled. So that's adding to this issue. And then you have, obviously the supply chain issues and inflation driving up the cost of products. So yeah, people are not looking to, builders are kind of being very careful about the new home builds that way, which again is just going to create this log jam down the road of that we need more houses that way. But in the meantime, housing prices appear to be safe. Jerry Howard makes a really good point that as this recession goes on, it may start causing home prices to drop, but that would be something that we see potentially next year that way. And a lot of the data that I've seen have shown that like we're going to go up in home values, specifically in this area, anywhere from like 8 to 10% over this year. And I've seen some data showing that we're going to have a drop of like 8 to 10% next year. So what I'm kind of seeing, I mean, if that's true, is that in 24 months, home prices may be back to where they are right now, which is nothing catastrophic, So we'll see some, good appreciation over this next year, and then some depreciation, similar depreciation, the following year that way. But again, it's important to make sure that you buy a home that you really like and that you enjoy and that you can afford, and you'll be totally fine through this that way. So.
Yeah, it's important to note that it's so much different this time around than the last housing crisis when there was a huge supply of homes. Now there's no homes to buy, and there's still tons of demand. So even though interest rates are higher than they were in the past, I guess in the past I should say during the pandemic, they're still relatively low in the big picture.
Right.
It's still there's still a lot of great loan products for people, and there's still a lot of opportunity for people to get into a home.
Yeah, no, there is. I mean, again, speaking with Stuart Broughton of Supreme Lending yesterday, a lot of the government-backed loans are around 5%, which, is not a bad rate. And especially if sellers are more agreeable to rate buy downs and things like that, you can come in and still get a decent rate that way. So, and again, what this all comes down to is how long the recession is going to take. Originally, I think people were being a little bit more optimistic and thinking that the recession was going to be kind of short-lived, 6 months that way, and everything would be fine. And now, I think most people are thinking it's going to be longer and drawn out. And so that will have an effect in the housing market down the road. Right now, we don't see that. But as the recession kind of continues to tick along that way, then potentially we can see it affecting housing prices. But again, it appears to be a ways out that way. So. Anything else you want to add?
No, I think that just about covered it. Let us know if there's anything you guys want to hear or learn about. And
yeah, just in the comments, just let us know if there's any topics that you want to hear about, and we'll if we don't know about them, we'll research them and address them. But Isaiah, thank you for joining today, and I hope everyone got a little insight about what's happening on the market. I'm Sean Payne with LivXplore, and we're signing off. Thank you for joining us.
Thanks, you guys.
Welcome to the LivXplore Podcast. If you like what you hear, please hit like and subscribe.